Hello everyone, in this video we will be going over A-Level Accounting 2023 February-March paper 2 question number 2. So this is the structured paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks, and we're also given a time limit of 1 hour and 45 minutes. And since question number 2 is of 15 marks, ideally we should be spending about 17.5 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 17.5 minutes. Also, I will be linking down the paper as well as the mark scheme in the description box. So without any further delay, let's get started. Jacob owns a restaurant and the business's financial year end is 31st December. The business owns many small items of kitchen equipment and the following information is available. So in this case, the kitchen equipment will act as our non-current assets. Now, on 1st January 2022, kitchen equipment was valued at 3,450. So this is our opening net book value. Then we have additional kitchen equipment which was purchased for cash 1,680 during the year ended 31st December 2022. So this is our additional purchases for the year. And on 31st December 2022, kitchen equipment was valued at 3,950. So this will be our closing net book value. Now for the first part, we need to prepare the kitchen equipment account for the year ended 31st December 2022. Okay, since this is our asset, we always put our opening balances of the asset on the debit side, which means that this value of 3,450 will go towards the debit side as our opening balance. And this is at the date of 1st January 2022. So that's 2022, 1st January. Alright, then we're also told that we had purchased new kitchen equipment worth 1,680. And since we're still talking about assets, all of the purchases will be recorded on the debit side. So we need to record this 1,680 on the debit side, but remember that we paid out cash for this. So we'll record it under the heading of cash. And since we were given that this was purchased at the year ended 31st December 2022, this will be our date. So that's 2022, 31st December. Then we're also told that the closing balance of the kitchen equipment was 3,950, and if the opening balance is on the debit side, this just means that our closing balance will be on the credit side. So that balance CD of 3,950. Again, this will be at our ending date of 2022, 31st December. Now, we still have one more item to be included in the kitchen equipment. And since we're talking about non-current assets, it's definitely going to be the depreciation charge for the year, which will be recorded in our statement of profit or loss. And since this will definitely act as an expense, it will always be recorded on the credit side. So that's going to be our statement of profit or loss. And this will be at the date of 2022, 31st December, since that's the date at which we prepare our statement of profit or loss. And this will act as our balancing figure. So let's figure out the total from the debit side. That's 3,450 plus 1,680, which results in 5,130. Same for the credit side. Now our balancing figure is just going to be 5,130 minus 3,950, which results in 1,180. And the next thing that we need to do is to show our closing balance as the opening balance for next period. So that's 3,950 as our opening balance. And this will be at the date of 2023, 1st January. That is all for the first part of this question. Let's move to the second one. Now we need to state 2 reasons why the reducing balance method of depreciation might be chosen by a business for depreciating non-current assets. So the very first reason is that it takes account of the fact that some non-current assets lose most value in the earlier years, because if we're calculating depreciation under reducing balance method, then the depreciation charge is going to be higher for the first few years as compared to the later years. Let's write it down. Takes account of the fact that some non-current assets lose most value in the earlier years. Then the second reason could be that it matches depreciation to earlier years when non-current assets provide most benefit to the business, because new non-current assets will provide higher benefits in earlier years as compared to the later years. So that's going to be matches depreciation to earlier years when non-current assets provides most benefit to business. This concludes the second part. Let's move towards the third one. We're now given additional information. On 1st January 2022, a new delivery vehicle was purchased in part exchange for the business's old delivery vehicle. Okay, so we have purchased a new delivery vehicle which will have the cost, and the cost will be funded by either the bank payment or our part exchange value. And in this case, we're told that the payment of 22,500 was made, so that will be our part of the bank payment. Then the old delivery vehicle, which had originally cost 24,000. So we're talking about the part exchange now. The cost is given to be 24,000. And it was purchased on 1st January 2020. So I'm just going to prepare a timeline right here. This is the year 2020. This is the year 2021, and this is the year 2022. We are told that the old motor vehicle was purchased on this date, and it is exchanged at the date of 1st January 2022. So it's right here, which means that the depreciation is only being provided to the year 2020 and 2021 before it was disposed. We are also told that the delivery vehicles are depreciated by 25% per annum using the reducing balance method, which means that we need to charge the depreciation to this old motor vehicle of cost 24,000 for the first 2 years. So let's figure out the depreciation charge for 2020. In this case, we don't have any sort of accumulated depreciation, so our cost will act as a net book value. So that's 24,000 times 25%, which gives the depreciation for first year to be 6,000. Now let's figure out the depreciation for 2021, but in this case our accumulated depreciation will be the depreciation of previous years. So the net book value is just going to be the cost minus the previous year's depreciation 6,000, which is now the accumulated depreciation, multiplied by our rate of 25%, which results in the depreciation charge for the year 2021 to be 4,500. So let's figure out the net book value. Now this is going to be the cost minus our accumulated depreciation. The cost is given to be 24,000, and the accumulated depreciation is just going to be the sum of depreciations for these 2 years. So that's 6,000 plus 4,500. And this results in the net book value to be 13,500. And we were also told that the old delivery vehicle was part exchanged at the net book value. So the part exchange value is also going to be equal to the net book value, which was of 13,500. Now the cost of the new delivery vehicle is just going to be the sum of the bank payment and the part exchange value. So that's 22,500 plus 13,500, which results in 36,000. Alright, now we need to prepare a journal entry to record the charge for the depreciation of vehicles for the year ended 31st December 2022. So the only vehicle that we have for the year 2022 is the one purchased at this date of 1st January 2022, and the cost of it was 36,000, which means that we only need to charge the depreciation to this value. So let's figure out the depreciation charge. That is just going to be the cost. Since this is the first year of purchase, there will be no accumulated depreciation, and we just multiply it with the rate of 25%, which results in our depreciation charge to be 9,000. Now we just need to record it as a journal entry. And remember that depreciation is always treated as an expense in our statement of profit or loss. And any expenses in the statement of profit or loss will go towards the debit side in case of journal entries. So we need to record the statement of profit or loss on the debit side with the amount of 9,000. And we clearly know that this is part of the depreciation amount, which will go towards our provision for depreciation of delivery vehicles. That will be the item on our credit side. That's provision of depreciation, and this is especially for our delivery vehicles. That's of 9,000. This concludes the third part. Alright, remember that we were given the working instructions, so instead of showing all of these here, just show it right inside this box. Now for the fourth part, we need to define each of the following terms. The first one is capital expenditure. So capital expenditure are those amounts that are spent on any sort of non-current assets, and the improvements or the amounts spent on any long-term benefit to the businesses. Let's write it down. These are the amounts spent on non-current assets and their improvement. Then the second one is our capital receipts. Capital receipts is the exact opposite of this. So capital receipts are just going to be the amounts received which are not related to any day-to-day operations of a business, or these are the amounts received which are of long-term benefit to a business. Let's write it down. So amounts received which are not related to the day-to-day operations of a business. This concludes the fourth part. Let's move towards the fifth one. We're given additional information. Jacob is preparing his business's financial statements for the year ended 31st December 2022, and the following additional information is available. So first we need to calculate the total amount for our capital expenditure. Okay, since this is talking about expenditure, we only have to look at our payments. So the first one is the purchase of new ovens. So the ovens is definitely the non-current assets. So this amount will be included as part of our capital expenditure. Then we have the installation cost. So installation cost is also a capital expenditure since it does not have to be repeated time and again after it has been done once. So it's to be included as well. We then have repairs to electrical equipment. But remember that repairs is something that needs to be performed time and again. So this cannot be our capital expenditure. This is our revenue expenditure. We then have maintenance of computer equipment. Again, maintenance is something that is to be done time and again. So this cannot be part of capital expenditure. We then have extension to restaurant. So once extended, the restaurant does not need to be extended time and again, which means that this will be part of our capital expenditure. We then have decoration of restaurant extension. Again, decoration is similar to installation because once it's done, it does not need to be performed time and again. So we should include this amount as well. So the total is going to be 5,600 plus 400 plus 85,000 plus 3,200. And this results in the total of 94,200. All right. Then for the second part, we need to figure out the total of our capital receipts. So we only have to look at our receipts now. Okay, so the very first one is bank loan. So once received, this bank loan will act as a long-term benefit to the business because it does not have to be repaid in a few months. It will have to be repaid in a few years' time. So this will act as our capital receipts. That's 25,000. Then we have 40,000 for additional capital provided. So again, this is capital provided, which will act as a long-term benefit. So this should be a part of our capital receipts as well. Then we have proceeds from disposal of unwanted furniture. Again, we're talking about disposing non-current assets. So that is not something that we do time and again in the business, right? So it should definitely be part of our capital receipts. So that's 2,800. Now the total will be 67,800. That will be the capital receipts. Alright, this concludes question number 2 of 2023 February-March paper 2-2. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.